Welcome back to another episode of the Exceptional Advisor podcast series. Hi, I'm your host, Bob Powell with the Investments in Wealth Institute. And joining me today is Omar Aguilar, Senior Vice President and Chief Investment Officer for Passive Equity and Multi-asset Strategies at Charles Schwab Investment Management. Omar, welcome back.
Thanks, Bob. It's very nice to be back.
Well, it's great to have you join us today to discuss one of the hottest topics in investing, behavioral finance, and how we are all finding it hard to navigate these uncharted waters. I think it's appropriate that we sat here a year ago to raise awareness about the benefits of behavioral finance for advisors and their clients, and to educate advisors and their clients about the biases that drive investor behavior and how advisors can help their clients identify and manage these behaviors and avoid common missteps. And now more than ever, advisors are turning to the world of behavioral finance to help make sense of it all and help them navigate these uncertain times. Eager to hear what you have to say about that.
Yes, Bob. I have to say, though, that, any adjectives that we can use to describe what we're going through, they're probably going to be short. I believe that advisors all over the world are experiencing so much anxiety, uncertainty, a lot of questions. We are in an unprecedented, circumstances, and 2020, I think, is going to be unprecedented. The number of times that I have used the word unprecedented to describe 2020. And I would probably say that this is not just an investment situation or a decision-making environment that is difficult. We clearly are in the middle of a health crisis that has not been fully resolved, where our emotions change day after day, every day or every month, every week. We get these emotions, these anxieties, the fear, the doubt, the uncertainty just gets through us, and all of us are starving to just get some sort of reassurances that things will be okay. I think it will be safe to assume that people look at the news, look at their phones for any sign of hope that things will actually get better. And because of the pandemic situation, that has obviously translated into one of the areas of behavioral finance is critical, is what do you do with your money? Not only we're seeing these uncertain circumstances affecting our daily lives, but now it's translated into what happens with our investments.
So speaking of investments, for the benefit of our listeners who may not be familiar with the field of behavioral finance, I'm wondering how you apply it in your role as CIO at Charles Schwab Investment Management.
Thanks, Bob. Yeah, behavioral finance is sort of been a very nice, trendy, name. It has been around for over 30 years, and it is a part of the investment science that basically is trying to explain things that are not easily understood by the just common concepts of mathematics or economics. Over the course of the year, the majority of the analysis of investing, equity markets, econometrics, macroeconomics, usually focus on things that are very tangible, things that you can explain either through equations or simply by just the basic rules of how economies operate. Behavioral finance was born because over the course of that period, there was a lot of information that was not easily explained. Classical finance theories, they were not very good in understanding how investors were making decisions. So behavioral finance is trying to connect three things. Number one, the basic concept of economics, they don't go away. Number two, the science that goes inside of our brains, trying to see how our brains operate under different set of stimuli. And number three, the psychology that goes into decision making. When you actually combine, how the different people react to information, and then try to put it in the context of the psychological behavior of human beings, that eventually translates into a very good way to explain why people make decisions, the way that they make decisions. Over the course of the years, Daniel Kahneman, which is won a Nobel Prize in economics for the work in behavioral finance, together with psychologist Amos Tversky, they introduced the idea of prospect theory. That was the first thing that they developed as part of understanding how people make decisions. And I'm sure this will be very familiar to most of the listeners, which is, it doesn't feel the same way when you win something than when you lose something. The concept of losing something, it is much, much painful than the benefits and the happiness that you get by winning something. And that is the concept of prospect theory. So when you actually start thinking about that there is no big symmetry between winning and losing, then you start realizing that a lot of these typical financial theories do not necessarily apply in the way that you apply decision making. I always give this example too, which is something that we analyze here at Schwab, which is, think about when you are on a plane. When you are on a plane and you feel some turbulence, part of your brain, mostly the limbic system, reacts naturally when you feel some turbulence. So anybody that has been on a plane and has felt some sort of turbulence immediately feels nervous, immediately feels that anxiety that something is going to happen. And that's very typical. That's part of the science that goes into all of us. And then at some point, then you start rationalizing that, yeah, it's just turbulence. We're in a plane and, the pilot knows what to do. And therefore, you start calming down. That's also part of us being in a very calm situation. Now, all of us, determine this in different ways because we're all humans. But those emotions and those rationalizations of our emotions is what behavioral finance is trying to explain. As a CIO, with professional money managers, with professional traders, with professional portfolio managers, we always get into the same understanding of what is the disconnect between what the market says and what the fundamental says, and trying to figure out how all these behavioral anomalies or behavioral biases are affecting the way that they make decisions.
And I imagine it's especially important to remember all that during conditions like the ones we're facing today in 2020.
Absolutely. If you actually just think about what we have gone through in 2020, the feelings that you can have the day that you realize that we were in a health crisis, and then combined with the fastest bear market in history, and then with a full recovery in the market since March of 2020, that, obviously it is very hard to explain with any mathematics. It's a lot of that is actually in our brains.
So, Omar, when we met a year ago, your firm had partnered with Cerulli Associates and the Institute on a survey to learn how advisors view and use behavioral finance when working with clients, and also to help advisors recognize their own behavioral biases and understand common generational biases. So now in its second year, the B5 Barometer 2020 survey revealed some very interesting insights and trends when compared to last year's results.
Yes, absolutely, Bob. It was very interesting indeed in a year like this year to find everything that we discovered in 2020. There were probably more interesting, insights than what we saw in last year. And that's the reason we're here today, to just let you know what we learned from this year's research, and also to try to understand how people can use these concepts and these learnings as we think about, the future.
Okay. So obviously there's a lot of great information in this year's survey findings. And if you had to narrow it down, what would you describe as the top 3 insights and takeaways for advisors?
Well, number one, when we set out to do the survey in 2019, our main objective was to create awareness among the advisor community. And we're very happy to report that for 2020, more advisors are using behavioral finance compared to last year. The majority of that has to do in the way that they deal with client communication. So that's sort of a very important as being sort of the number one finding of this year's survey. The second one is that advisors are seeing a significant amount of benefits of using the behavioral finance concepts to help clients in the middle of the market volatility that we observed in 2020. Amidst all these uncertainty we have seen, understanding the levels of risk that the clients need and feel comfortable with has been, critical use of behavioral finance concepts, as well as the way that they communicate with their clients. And the last point I would probably say, the number 3, is that, since the worst possible part of the crisis in the first quarter of 2020, advisors that use behavioral finance concepts in their practice have actually gained more clients, and they have been able to adapt their client communications to continue to expand their practices. So we see great benefits of last year's survey and how these translated into this year's findings as advisors continue to use these concepts.
Mm. So when you set out to survey advisors around the country, obviously you were doing this in the middle of a global pandemic. I'm certain that you discovered some things that were surprising and some things that perhaps weren't so surprising.
Yes, absolutely. I would actually say that there were probably more things that were surprising than not. And I would say that just generally speaking, as I said at the onset, I don't think any of us really had any idea how this 2020 was going to just shape up. And, we're so far haven't been done with 2020. So I could probably just hope that things will just get better from here. But there were things that were not surprising, things that were basically the same as we had last year. And one was that people realized that behavioral finance was going to be critical in understanding how to deal with the uncertainty, the volatility, the coronavirus crisis, and advisors that use in behavioral finance saw the value in doing so. So that's something that was not surprising. Those advisors that use the concepts of behavioral finance in being proactive in working with their clients and adapting their communication style were in much better position than those that did not use behavioral finance concepts. So those were things that were definitely not surprising. Things that were incredibly surprising is that there were 66% of the advisors that use behavioral finance that they said that they did increase their business and they gained clients after the crisis of Q1. And that was almost twice as much as the ones that didn't use behavioral finance. So the fact that people were able to connect, and I will use that word clear, connect with the client using the concepts of behavioral finance, allow advisors to gain more business. And then the last piece that I thought was also very intriguing and surprising was that those advisors that do not use behavioral finance concepts, they were actually more preoccupied in trying to reduce risk of their clients in Q1 than those that use behavioral finance. In other words, they were more concerned, and that's very typical, of their own biases and less about their clients' biases, and therefore they were very much trying to reduce risk in their strategies more than those that were thinking about behavioral finance and talking to the clients and communicating with the clients.
Interesting that that advisors have to sort of separate themselves from and their biases from their clients and their biases too. It seems like that's a tall order.
Yes, it is. It's as I always say, which is probably the key part of a lot of the discussions I have had this year on behavioral finance. We are all humans and we all have biases. It doesn't matter who you are. And believe me, the pilot that is in the flight, when they feel turbulence, they also feel nervous. It's just a natural thing for all of us. It's again, science. It's just evolution. And therefore, professional money managers, CIOs, clients, advisors, we all have our biases and we all have to manage them.
So as you think about the survey, are there some noticeable differences between 2019 and 2020 that are sort of worth noting?
Yes. So one is, what I described before, things that we know is that, yes, the objective that we had last year of providing and creating awareness among the advisor community has actually worked. So I would probably say that there is more advisors using behavioral finance in their practice compared to 2019. And that is obviously something that we feel very proud and very happy. The partnership with Cerulli and the IWI has actually worked really well to create that awareness. And therefore the results in 2020, show that improvement in terms of the number of advisors using behavioral finance concepts. The second is behavioral finance, it has more of I would praise a mission, which is it allowed advisors to help their clients navigate to these uncertain times. If there was anything that I feel strongly about is that the concept of behavioral finance usually work better, in periods of crisis, because that's exactly what most people make, biggest mistakes. Usually it's at the time where you are in a stress and your time where things are actually not easy, when you actually end up, or those biases get triggered. So, the results that we saw of this survey just shows that, advisors allow and help clients to stay invested in the market, and make sure they were comfortable with the levels of risk they take, as opposed to not. The third, observation we had for this year's survey, it has to do that the fact they're being more self-conscious about their own biases, and they feel very comfortable, talking about their own biases. And as you alluded earlier, clearly, the differences in what advisors' biases and clients' biases are usually tend to go at odds. In this particular case, what we saw is that advisors, felt very comfortable reporting that loss aversion and overconfidence were the most critical things for advisors, and therefore feel comfortable, working with their clients to just overcome their own biases. And then the last observation, which I thought it was also very good for the results of these years survey, it had to do with the fact that, those advisors that use behavioral finance, they use the current markets to find opportunities to enhance portfolio strategies and do things that will work for the client's investment objectives, more than those that did not use behavioral finance in their practices.
Interestingly, as part of the Exceptional Advisor in Extraordinary Times series, we've talked to a number of advisors, many of whom use these tactical investment opportunities, whether it was for Roth conversions or tax loss harvesting or just general rebalancing and anyway, it just seemed like a good opportunity for people to not only be strategic, but also tactical.
Yes, absolutely.
Yeah. So what biases have you observed during the most, that were most pronounced during and right after Q1 and the Q2 market volatility, and how does that compare to the survey findings?
Well, it is kind of interesting because we did, as I said, this year was probably, the year where we saw the most changes in different responses to different events in the market. So let's just go through the timeline and figure out what that is. And this is well reflected in the way that the results of the survey. Again, the survey usually just gets a snapshot at one point in time. But if you start going back to the early part of the year, and again, this looks like so far back into the past that nobody remembers pre-COVID what the world looked like. But back in those days, the majority of advisors were just really more concerned about the trends in the market, concerns about the China-U.S. relationships, concerns about what the U.S. elections may look like, et cetera, et cetera. When we started to get into the health crisis that translated into an economic recession, the number one bias that we observed that was reflected in 2020 was the loss aversion. Very typical, emotional bias was very evident in the way that people, decided to go and look for flight to quality. They look for safety assets. They rush away from equities into sort of more safer areas, and even within fixed income, move away from corporates into cash, and even within that area, always looking for government securities. As we went into this process, central banks intervened, central banks provided liquidity into the whole concept. The market hit bottom in March of 2020. And then since then, we saw an amazing, jump into the market and a full recovery of all asset classes, particularly in certain parts of the risky assets like equities that observed in second quarter of 2020, the best performance they have seen in history. And that obviously translated into other biases, mostly cognitive in nature. And what that does is basically had the second bias that was well reflected in the 2020 survey, which is overconfidence. So as people felt that, in general, that the market was supported by the Fed, that the market was going to stay, the course, and that in a way that the central banks were not going to let another huge financial crisis like we had in 2008, immediately the overconfidence bias, came in. So loss aversion followed by overconfidence were two of the key biases we observed. And the last one, which is the most, probably say, unique one for this crisis, was confirmation bias. And the way that I describe confirmation bias is that you basically look at around you to confirm your point of view. And that's the only way that I can explain people lining up for toilet paper. Confirmation bias is exactly the reason why, people will basically, for no other thing other than confirmation biases, will try to go and get toilet paper. And toilet paper was actually in more demand than gold at the time. So those were the three things that we observed compared, to the survey in 2019. It was overconfidence, loss aversion initially, and then confirmation bias as the third.
Mm. Can you talk a little bit about the degree to which you notice recency bias?
Yes, so recency bias is interesting because if you recall, that was sort of the number one bias that was portrayed in the 2019 survey. And recency bias is actually something that happened in between. Recency bias is usually those where you actually think that the trends that are happening now will continue to have. In other words, you're only moved by the most recent information. That's the reason you actually call it recency bias, because you're affected your decision process by the most recent information. So whenever we're going into the fastest bear market on record, the recency bias was reflected that people continue to pile on and then try to get out of it and trying to seek liquidity. At the same time, even now when the market has actually had a significant rally, people continue to think that this rally will never end. And therefore, they actually have that recency bias. In normal market circumstances, without those big swings, that seems to be, like we observed in 2019, a very typical bias. In this year, I would probably say that it was in between the biases. So you actually think about loss aversion, recency bias, overconfidence, and recency biases all together in a sequence.
Right. And you notice that advisors were citing recency bias as the most common client bias. There's another bias it seems to that they noted as well, which was familiarity bias, which is something I'm unfamiliar with.
Right, and those are very typical derivatives. Yes, the client's recency bias usually is just a collection of obviously working with the advisor, and the advisor, the number one question that clients usually go and ask the question is what's happening next, and depending on the answer of the advisor, that's where recency biases gets reflected. So that's the reason clients tend to react very quickly to that recency bias. The second one is a derivative of that loss aversion. When you are in these incredibly high uncertain times, and you actually have that loss aversion kicking in when you're trying to protect and you're trying to go to safety, you do the flight to quality. Immediately, the number one thing that you have to go is you got to go to areas you're comfortable with. In the majority of cases, is things that you like. You're loyal to a brand. You're loyal to domestic securities as opposed to international securities. You always go with the comfort of something that you become familiar because you think it's safe. So, clients usually reflect, and the survey reflects those as the client biases, as something that happens as a reflection of their loss aversion.
Mm. And the survey also noted a notable increase in the number of advisors that reported framing bias and mental accounting. Can you elaborate on that too?
Yes, absolutely. In many cases, what happens with mental accounting is a very typical cognitive bias where, people are trying to find different sources of assets and try to bring them into different areas. They separate wealth into different buckets. It's almost like when you're in elementary school or middle school and you have your lunch money, you obviously want to save your lunch money for lunch. And so in typical environments of uncertainty, you always try to separate certain parts of wealth and try to keep them separate to say, all right, well, I can actually continue to work on this part of my assets, but that one, which is for retirement, I'm not going to touch it. So that's very typical, again, another derivative of loss aversion. And then framing is usually more, with clients in the way that the information gets presented. And again, this is very important for advisors, because those advisors that use behavioral finance concepts, when they come down and discuss this with their clients in the sense of understanding their needs and understanding what is the client really wants, that component allows them to be more successful because precisely of the framing bias they have. If you actually go in front of a client in the middle of a crisis and basically say, everything is bad, we're just all going to just die of coronavirus tomorrow, clearly that framing, for certain, clients that are emotional in nature will trigger decisions that are not right. On the opposite side, if you go completely over promissory and say like, oh no, things are going to be great. Tomorrow things are all going to be gone. We're back to normal. Everything is going to be great. There are certain clients that will basically potentially, trigger and start making other decisions that are not right. So that framing is something very typical that happens. And again, the concept of behavioral finance, helps advisors provide the best framing for their own clients.
Mm. So obviously, Omar, you're an expert in the asset management industry. I'd like to turn our attention to portfolio construction and investing trends. What changes have you and your team made, either intentionally or intentionally not made during this year's volatility, and how are you positioning portfolios for the second half of the year?
Well, Bob, this is a very interesting question, and we get them all the time. So the first thing that I would say is, and I will admit it, and I think I'm very honest with my team as well, is, hey, we are all humans here. I don't think we're anybody of a superhero. That we have no feelings whatsoever on anything that happens when the market goes up and down the way they had. Again, just think about it. A bear market within 2 weeks is something that I think is very hard for people to grasp on. And then a significant rally in the market since then is clearly something that is difficult for people to understand. However, some of the things that we have learned over the years and experience is that we have to focus our attention on things that we can control. Parts of the market that we cannot control and things that we cannot control, we try to minimize. Because of that triggers our behavioral aspects and our own personal biases, we try to minimize those as much as we can and focus on processes that we have full control. And those include portfolio construction, risk management, and systematic trading. Those are the three things that I would probably say that we have focused over the course of 2020. Starting with risk management, understanding what is our risk budget and understanding what is our investment objective in the long term is key for us to understand, to continue to make decisions on behalf of our clients. And again, that's something we can control. That's something that advisors, could work with their clients to understand in this environment. It is something that they like and something that they feel comfortable with the risk level they're taking. Number two, portfolio construction. I think you alluded it earlier that opportunities that like what we saw, even at the worst possible of the market, of rebalancing, of understanding the tax loss opportunities that you have to harvest losses when you have long-term gains that you never wanted to trade because you didn't want to realize those gains. These was the perfect opportunities for us to just make changes. At the same time, trying to create that level of diversification that probably we never had the opportunity because it was very hard to implement. So portfolio construction became very critical for us during this time. And the last thing I would say is being systematic about it. One way to mitigate the effect of our own human biases is to be completely disciplined about it. And in many cases, a lot of portfolios, a lot of strategies, if not all of them, they got in disarray in the middle of the crisis because, again, there was a significant change in the prices and in the returns of those assets. And therefore, staying, very disciplined in the way that we rebalance and maintain that discipline going forward by focusing on the long run continues to be sort of a big part of how we mitigate those potential biases that may hit us. And at the same time, recognizing that uncertainty will continue to be with us.
So that's how Schwab is positioning portfolios. Can you talk a little bit in returning back to the research, how advisors are positioning and adapting their client portfolios, particularly after Q1? Can you speak to those findings and share your opinions on that?
Yes. So again, this is a very interesting result from the 2020 survey results. I think breaking this into those advisors that are users or that have experience in behavioral finance, They actually ended up spending probably most of the time in communications and assessing risk with their clients. They use this opportunity for, I think, as you described it earlier, to do more tactical rebalancing of strategies to try to take advantage of the tax loss harvesting opportunities. At the same time, being incredibly open and transparent with their clients by maintaining their levels of risk that they felt comfortable and then focusing on the long-term investment objectives of their clients. For those advisors that are not using the behavioral finance concepts, the majority of the activities, have been since the bottom of the market to continue to reduce risk in their portfolios. They have expressed that downside protection and client assets is sort of the number one priority, which again, the challenge in many cases, as we saw in 2008, and also what we saw this year at the bottom of the market in March, is that, normally when you de-risk, it tends to be at the worst possible time because you don't know, obviously, if things will actually come back like they did, at least in the last 3 recessions that we have had. Similar to 2019 results, the majority of the reason why clients change their investment goals or risk tolerance, it was something that triggered portfolio changes with advisors. So in 2020, the majority of the advisors that use behavioral finance concepts, rather than trying to change the goals on the fly, they basically ended up working with their clients to replace some of the underlying opportunities or underlying vehicles that they had, and then maintain the level of risk that they felt their client was good. It was very clear, how those advisors that use behavioral finance, they were actually very, very strategic and tactical in the way that they executed. I would say strategical in nature by diversifying, and tactical in the way they executed, as they were into the process. We continue to see this. We continue to see that a lot of advisors, as I said, are trying to go towards model portfolios. They're looking to opportunities to understand their role in working with their clients and try to create their personalized and customized solutions for their clients. But at the same time, is trying to be very disciplined in the way they follow their own asset allocation models.
Mm-hmm. So where do you see us going? What's the road ahead look like? Any advice for advisors on what they can do to apply the research findings in today's climate and beyond?
Well, it's it is a very interesting part of our investment life. Clearly 2020, is teaching us a lot of things already, and I think the road continues. I don't think we have seen the end of what 2020 comes ahead, unfortunately. But what we do know is that there's been a significant progress, made from last year to this year. We clearly see that advisors are seeing the value of using the behavioral finance concepts in their practice. They clearly starting to see how clients react positively to the way that they get addressed and the communications in keeping those relationships, stronger, even in the middle of the biggest crisis like we have seen in 2020. We still believe that the biggest work that we need to do, and therefore these kind of interviews are critical, is that we need to continue to find a way to translate theoretical concepts and explaining these in a way that advisors and clients can easily understand. The main reason why advisors tend to be a little gun shy in using these concepts in many cases is because A, they don't have the tools, or they simply just don't find the opportunities to be able to explain these concepts to their own clients. So having tools available, having ways for them to understand their own biases, and at the same time to translate those concepts into the client is something that I think will continue to be, critical in the road ahead. We at Charles Schwab Investment Management, along with the IWI, we continue to be committed to helping advisors in this area. Education is critical for the IWI, and we're committed to support it. And we have invested tremendous amount of time and energy into providing advisors with all the tools and education that they can have so that they can use with their own practice. We have designed a program we call Diagnostics, which is trying to understand what are the biases that advisors have and their clients have, and trying to create this program that allows them to find ways to work with their clients directly using behavioral finance concepts. And also we know that at IWI's behavioral finance curriculum, there is a lot of educational resources that explain how to work and how to introduce these concepts into everybody's practices.
So any final advice for our listeners? Anything that we haven't touched upon that you think we should, or anything that you've already spoken to that you want to reemphasize?
Well, I would probably say that, the number one thing that I would like for people to remember from this podcast is, you're not alone. If you as an advisor or you and your clients feel anxiety, sometimes, you don't know what to do. You feel paralyzed with what's going on. The headlines, the media, everything just basically becomes overwhelming. That is a very common thing that happens across all of us. As I said, we never imagined that our lives were going to be turned upside down the way that we have had in 2020. And when you translate into investment decisions and their journey that we have had as the market diverges from the economy, we clearly see how this conundrum becomes, so difficult. I would probably say that, for advisors, understanding, their clients' needs and figuring out what the client wants and trying to find that middle ground in between what the client wants and what the client needs. It is clearly the role of behavioral finance and the role of the advisor, maintaining those relationships, maintaining the client invested, despite the fact that the market is going up and down, and trying to find opportunities for them to enhance their investment lives. It is clearly something that we're all in this together. And I know in our partnership with Cerulli and IWI, on behalf of Charles Schwab Investment Management, we are very pleased to provide the tools and the education to help them enhance their practices and help their clients in periods like 2020.
Well, Omar, I'm afraid we've run out of time. I have many more questions I could ask, but I think this will give folks a taste of things to come from at the conference and on the Institute's website.
Well, thank you very much, Bob. As usual, good luck with everything. And, I'm hoping to actually do this again. And hopefully by then we'll have good news about, where we're heading with this crisis.
Yeah. So it was a pleasure having you here with us today. Look forward to having you back on perhaps in a year from now. For all you listeners out there who are chomping at the bits, you can go to the Institute's website, investmentsandwealth.org, to get access to the resources and the training you need to apply these principles into your own practices. The Institute has a behavioral finance resource center filled with research, articles, courses, blogs, and conference information. And you could access the survey results and comprehensive report too as well there. So thanks again for listening to the Exceptional Advisor Podcast.
Important disclosures. All expressions of opinion are subject to change without notice in reaction to shifting market, economic, and geopolitical conditions. Information presented is for general informational purposes only and should not be considered an individualized recommendation or personalized investment advice. The types of securities and investment strategies mentioned may not be suitable for everyone. Each investor and advisor needs to review a security transaction for his or her own particular situation. Charles Schwab Investment Management is not affiliated with the Investments and Wealth Institute.